Julia Lee, a close, well, almost the dictionary definition of flat, up for the week, down for the quarter though.
It was the end of the week, the end of the month, as well as the end of the quarter. And if we have a look at the Australian share market today, it was extremely slow. Stripping out the options expiry and the activity that went with that, it was an extremely slow day on the Australian share market. And I guess part of that is because we see a raft of holidays around the region on Monday. In Australia, New South Wales is on holidays, and around the region we see South Korea as well as China on holidays. For the week, it was a positive week, up by 2.7%, but for the month we were down 6.1%. A lot of traders, investors would have been hoping for a better month after a terrible August. So as you can imagine, for the quarter, down by 13%, and the worst quarterly performance that we've seen since the December quarter back in 2008. We did see a bit of a mixed lead come through from the US overnight. It was an extremely volatile session, but we saw better data coming out. If we have a look at the initial jobless claims, 391,000, so back below that 400,000 mark, and the GDP numbers revised upwards to 1.3%. But of course, being the end of the quarter, we would have seen some window dressing as well, and this is where some fund managers will try and buy those areas that outperformed and sell those that underperformed. And if we have a look at for the quarter, the area that underperformed was the material space, which was down today, and the area that outperformed for the quarter was the telecom space, which was up today.
Interesting to note, over the past few days, we've seen Europe have to struggle for the oxygen of headlines because China has emerged. In particular, fears, as John mentioned there, and yourself mentioned a little earlier, about this potential hard landing, and yet trying to scour the news flow for where exactly the substantial reports and the evidence for a hard landing in China has come up a little bit empty.
So I guess the market's starting to price in the possibility or a higher probability of a hard landing in China, which would be defined as sub 7% growth. And we've seen a number of investment houses come up to raise the probability that we are going to see a hard landing in China. I think the presentation that's doing the rounds is a Bank of America one, which has come through from the head of equity strategy in China, David Cui. And if we have a look at his presentation, he focuses in on the financial sector, and the risks in the financial sector seem to be rising, which could crimp growth. We've also seen Fitch's head of sovereign debt ratings, Andrew Colquhoun, come out to say that the main risk to China's growth is the banking sector at the moment. And if we have a look at China, it's in a weaker state than before we started off the global financial crisis. If we have a look at what happened during the global financial crisis, we saw massive stimulus and massive amounts of money going into the property sector, and Fitch coming out to say that we could see non-performing loans rising to as much as 30% of total loan values. So that's quite a huge amount. So I guess the market watching this very closely, and it's at the same time we are starting to see a slowdown in Europe as well as in the US, as John mentioned. So some concern over this. We did see those luxury brands being hit quite hard overnight on concerns about a hard landing. We have a look at Louis Vuitton, Moet Hennessy was down more than 5% in Paris. We also saw Burberry down more than 8% in London. So I guess the market's contemplating the possibility of Chinese growth slowing down to around about that 7% level, and it's the banking sector, the property space, that markets are watching closely, as well as a slowdown that we are seeing in the US and Europe.
So Julia, we've just closed the book on the September quarter, on the month of September, and obviously not a good performance. Certainly the quarterly performance down 13%. I mean, largely that was done without fears over China. As we move into the next quarter, the December quarter, do we go in with more concerns? Do we go in with any sort of optimism over a resolution in Europe? What sort of a trading sort of pattern and level of confidence do you expect?
I think we have seen some sort of impact in terms of the slower growth rates expected from the world and from China over the last quarter, and that has been reflected in copper. If we have a look at what drives copper, it is urbanization, growth in urban communities, especially coming out of China and the US. And we've seen copper prices in the last 3 months down by a massive 25%. And that's been a key driver of the losses that we've seen in the Australian share market, where we have seen the material space losing 19%, and oil, which is the other barometer of global global growth, down by 17%, or the energy sector down by 17%. On the flip side, we have seen some of those safe haven assets doing well. In fact, the only sector to gain this quarter has been the telecom sector, with a gain of just over 7%. But gold's been a good performer, up by 7.6% despite that pullback that we have seen. Oil hasn't. We've seen some sharp declines in oil, copper prices, commodity prices in general, and indeed in some of those material stocks where we have seen Murchison Metals down more than 50%. Capital raisings have been a feature this week. Paladin and Goodman Fielder have come out. In the last 3 months, both of these stocks have lost about 50% in value. On the flip side, though, we have seen the stocks that outperform, really driven by takeover and acquisition activity, merger and acquisition activity. If we have a look at Bow Energy, the best performer in the ASX 200, up by 65% after that takeover offer from Arrow Energy. And then if we have a look at the other outperformer, it's been MacArthur Coal with that takeover offer from Peabody and ArcelorMittal, so that stock up by 45%. Before the quarter, down 13%, which makes it the worst performing quarter since December 2008. And in fact, it's quite scary going back to 2008. So if we have a look at the Australian market back in 2008, all 4 quarters in 2008 were actually down. The March quarter, we saw a loss of 15.5%. In the June quarter, a loss of 2.6%. The September quarter was a loss of 11.8%. And then the December quarter down by 19.1%. So unfortunately, not a good comparison to be making our market to 2008, down by 13% for the September quarter this year.